Welcome back to the Real Estate Standard Podcast, episode 22, where commercial real estate and Bitcoin collide. I'm Tim Kotzman. It's June 1st, 2026. I'm joined by Kenny Alves and Chris Drizga. Each episode, we break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we're joined by Ben Werkman, the Chief Investment Officer at Strive. Before we dive in with Mr. Werkman, I'll hand it over to Kenny for an update on West Main storage stacking.
Thanks, Tim. As of today, June 1st, we hold 14.62 Bitcoin. So that's 1.4 billion Satoshis. And we've done most of that so far in 2026. We've stacked 12.4 Bitcoin this year so far. And our Bitcoin yield to date is 568%. So what does that mean? That means we 5x'd our Bitcoin stack since January. Our Bitcoin per square foot, you can see the chart on the screen, is at 21,060 Satoshis. So we're creeping up to our Bitcoin parity level, which is 21,649 sats per square foot. We just received our latest digital rent payment from Strategy. We got in a little over 9,500, $9,597. And that's like the equivalent of about 33 10 by 10 storage units. And this is going to increase our net operating income by roughly 15%. Our Bitcoin is covering about 4 years of mortgage payments as we speak right now. And so we're chugging along. What do you think, Chris?
Yeah, the flywheel is spinning and it's only picking up speed here. I think just the diligence you've had over the last weeks and months here, as far as just continuing to execute on the strategy, stacking sats from the free cash flow, and ultimately diversifying into the digital rent component here is exciting. And as our guest here is infamous for saying, you can't rent other people's conviction. We have developed our own conviction, and we're executing it every single day. So looks like we got a little bit of a dip here on this week's purchase again, and I'm excited about that. I think it's just gonna add to the overall performance and reflexivity here as we come out of this bear market. So those are my thoughts for the day. Ben, thank you so much for making time. We know you're a busy guy these days.
It has been certainly been a very busy couple of weeks, but before we jump into any of that, I just want to say I think what you guys are doing here is really, really cool. When we came out and kind of the treasury play became a thing, it got shoehorned into one single model. And I think it's important that each different industry start to show what that approach looks like on a Bitcoin standard. And so seeing what you guys were doing and looking at the chart with steady progress over time, I think we need a lot more of that out there. And I don't think there's a good template for other people to integrate these into their businesses. So seeing the progression every week at the beginning of your show and seeing how you guys are applying this to a completely different type of business, than what we're doing off in the structured finance world, I think is incredibly cool. And I think it's going to be a really valuable resource for people when they find it, to show them you can recreate this for yourself, right? There is no one-size-fits-all model. What you want is Bitcoin at the core of your balance sheet, and how you design that around your business is totally up to you. So I think it's really awesome what you guys have been doing here.
Thanks for the kind words.
Yeah, thanks for saying that. We think so as well, and we're just trying to put in the reps here in the bear market, and waiting for folks to recognize that we're not as crazy as you may think we are.
You'd be surprised what being resilient during a bear market does over the long term. The people that have stuck around in the space have had to ride out a lot during the bear markets. It's never popular. It's never been a popular play during the bear markets. And so the people that stay out there and they're consistently sticking to a strategy, deploying against that strategy, tracking it, communicating it, staying out there in front of the public, that's where conviction's built, right? Everyone has really high conviction when the market's ripping. It's what happens during these periods where you start seeing that weakness. And, that saying that you brought up that I love to say, you can't rent conviction. I think that's critically important for people to internalize, right? You don't really figure out how convicted you are until you reach a point where it truly starts to test you. Everyone has to get to that moment where they go, maybe I was wrong, right? And you got to re-dig in, reevaluate the strategy, think through what you're doing, look at how you're managing it, make changes, make tweaks, figure out how to put your business in the best position that you possibly can to endure. Because inherently, if you have a base understanding of Bitcoin, you're going to have to go through those periods. And I think a lot of people are going through those periods right now. We certainly had one in the treasury space. Until recently, I was saying the treasury the treasury sector was the only one that had a full cycle. Bitcoin wasn't really following the true cycle. Now Bitcoin's, following the cycle once again. So now everybody's getting a feel of it. But until you go through that full cycle and you get to the depths of that bear market, and you have to step back and reevaluate what you've been doing and figure out, are you comfortable with the way you were managing it? Did you hold enough in reserve? Did you give yourself enough cushion to ride out the bear markets? That's the critically important part about deploying one of these successfully.
Absolutely. I think the Bitcoin community definitely knows who you are, but we also have a number of commercial real estate folks that may not be familiar with who you are and what you're doing today. So, maybe before we get into Bitcoin and the digital credit topics, let's start with your background. You had shared with me recently that you were in the commercial banking sector during the great financial crisis. And obviously that period was defined by significant residential and commercial real estate distress, and ultimately played a major role in how the credit issues worked their way through the system. So I think that's an incredibly valuable perspective, and you may have some interesting insights and antidotes from that period that you may apply to what you're doing today. You obviously had a really interesting seat, not just from the outside, but also a front row seat from the inside there. So I was hoping we could maybe start there and just share your background, but also talk through some of the lessons that I think connect directly to the conversation we have here every single week, right? At the intersection of commercial real estate, Bitcoin, and now digital credit. We're trying to figure out what the heck the future of commercial real estate investing looks like. And I think these pillars play a pivotal role in that.
Yeah, absolutely. Yeah, it was a really interesting way for me to enter the job market. Coming out of college right after the great financial crisis was a really interesting time. And I actually had to pivot entirely. The entire time I was going through college, my plan was to be a financial advisor. That's what my dad did. I always loved investing. I always loved estate planning. And so that was where I thought I was going. But you can imagine when you get to the other side of one of these financial crises, the people you're looking to for the entries into those markets may highly sway you in another direction because it wasn't all that fun. And where I found myself was commercial banking. I got into that role. My father-in-law was the CFO of a trucking company at the time. And so he helped me get into a smaller regional bank here in Michigan. And I started out in the credit department. So I was doing all the loan underwriting for about the first 6 months that I was there. But then things started getting really bad. All the loans on the book were effectively becoming non-performing loans. We always called them special assets. So our special assets group was expanding greatly, and it became a real problematic time at the bank. It was one of those times where you're working for a company and you truly don't know how long that company is going to stay in business for. And I looked at that and thought, well, whether the bank is ultimately going to survive or not, it did in the end. The place where you're going to learn the most is going right into the fire and seeing how you come out the other side. What can you do to steady the ship? What can you do to push this thing forward? And so I shifted from the commercial credit group to the special assets group, where we were effectively responsible for all the bad loans on the book. And it was a totally different view into banking than I'd ever seen. When you come into banking as somebody young, one of the first things you're interested in is who are all the people that are making all the money and how are they doing it, right? You're finally seeing the business owners. You're seeing which businesses are successful, which ones aren't, which ones are always causing you problems. And what was very interesting was at the beginning of that, the first thing I was gravitating towards going, all right, here's what I'm going to do later on in my career was commercial real estate. Because all the deals I was seeing that I was underwriting in the early days were all large commercial real estate developers and even a lot of large residential real estate developers. And so you could clearly see that there was something to that industry that was generating a lot of cash or a lot of value. And when I got into the special assets group, it flipped on its head immediately. And it really changed the way I looked at risk very, very quickly. So the first thing that we had to do was we were going through this book of all the bad loans. We had to prioritize them, figure out where our biggest exposure was, and then we had to figure out a way to work out of these scenarios. Everybody thinks at a bank that what you do is you just foreclose and you take the assets and you move on. And, that's one of the options. But as a bank, you really don't want to do that. We don't want to be in the offloading collateral business. That's a lot of work. It's expensive, right? What you want is for your customers to pull through and continue to make it. So in the early days, it was actually less about, taking back collateral and liquidating assets. And it was more about restructuring the loan agreements, putting forbearance agreements in place. That was really where the vast majority of the time was spent. And what you were trying to do during that time, the bank was in trouble, our borrowers were in trouble, you became partners. Nobody thinks of their bank being their partner, but I can tell you during the global financial crisis, we were jumping through all the hoops we could and trying to broker whatever deals we possibly could to keep all these borrowers afloat, because the last thing we wanted was all the collateral back. And what really struck me after I was in that role for about a year, when some things started unwinding, was you would go back and you would look at the history of these loans. And at the time, you're underwriting both the individual borrowers, because a lot of these loans through the smaller banks have personal guarantees against them. And you're looking at how they were valuing the assets, so the commercial real estate, the residential developments, whatever it may be. And you just watched the precipitous fall that happened. I watched people that were, multiple 8-figure type borrowers go to zero within a matter of months through something that they didn't do themselves. Now, everybody always has their own part in their own story, right? You controlled it, but there are certain things that can hit your industry that were not in your control. You could have been a responsible buyer, but if the floor falls out of the market you're operating in, there's only so much that you can do. And so it really shook me quite a bit to see all these people who were big names in the community that everyone would recognize. They were major developers. And all of a sudden, all of them were on the verge of bankruptcy, right? They were losing all their properties. Everything was getting called back. You had the personal guarantees getting called in. So you're using personal assets to pay off these loans. It was one of those times that really does shake you, and it makes you rethink things. And it might sound weird knowing, for anybody who does know me, who knows where I was at on the strategy journey and the options plays and all those kinds of things. But at the time, it swayed me away from investing, right? It really put me in the mindset that I just needed to hold on to cash, right? And that stuck with me probably for the next 4 years before I could really pull out of that, because you just saw so much damage happen to so many people. So it was a very interesting way to start out a career. So I did that for a little over 2 years. And then once we got to the other side of it and we did stabilize the bank and, the economy started turning back around, you started having buyers back in the market for the assets. So people were able to refinance the loans and keep moving forward. Then I moved off. I went and did consulting. I was at KPMG for about a decade, where I did a lot of technology outsourcing and strategy consulting. A lot of that was at Fannie Mae, another very interesting place to be at right after you went through all these troubles with the loans at the bank. So that was a very interesting landing place to be, to get a front row seat to what that looked like. But after that, I really went deep into the investing world, and I started to learn how to code, of all things. When COVID came around, everything got thrown on its head. And, I'd had success with the strategy play. I'd had success with a lot of other investments pretty early on. And I decided I really wanted to get into the digital asset space at the time. So the very first time that I got into Bitcoin was 2013. And Bitcoin at that time, I think, was around $264, which is crazy to look back on now when everyone's freaking out about it being around $70,000. It wasn't all that long ago. And I got in and I screwed it up like most people do, right? You find something like that, it appreciates in price immediately. You trade it. You feel like you're the next Warren Buffett of investing at the time. And then it collapsed. And so I kind of stayed away for a couple of years. I had that moment where I said, thank goodness I avoided that catastrophe. I'm just going to go back to regular boring investing in the equities market, and I'm just going to stick with that. And it wasn't until it was about 2 years after that, maybe 2.5, where I came back and I started seeing it pop up again. The talk about Bitcoin had just died off after it pulled back after 2013. And I started getting interested again because when it didn't die, I was convinced that it was going to die at the time. Like everyone was selling off, it was over, there were no buyers, the price fell out from underneath it. I was like, this thing's dead. And it didn't die. And that actually caused me to take a much deeper look at it. In the early days, I didn't really have an understanding of Bitcoin. Of all the places, I saw it in a newspaper article. That's where I first saw Bitcoin. So it tells you, makes it feel a lot longer ago than it actually was. But after that, when I realized that this thing came back and now it was running again and it was starting to get all this new attention, I almost started panicking because it felt like one of those moments in your life. And I've got a strong belief that everybody, will have 3 to 5 opportunities in their life that would be life-changing opportunities. I was starting to feel like I was missing one of those, right? One of those was getting away from me. And so you immediately go into a panic mode where you're not going to be able to live with yourself if you don't, at least get back what you sold, right? And so at that time, I just started throwing myself into Bitcoin and doing everything I could to scrounge up money, to be able to buy as much Bitcoin as I could get my hands on. And the longer I stayed in it, the more convicted I became that Bitcoin was going to be the answer for me. And it didn't stop me in the early days from trading everything else, right? I've had my trading sins with all the altcoins, the same as many other people. And I was building algorithmic trading platforms to trade around those assets for several years during this. But after a certain period of time, it just became so abundantly obvious that everything was going to go to zero against Bitcoin. And it wasn't just because it was the one that I'd chosen, right? You were watching the market speak. You were seeing all of these other assets start blowing up around it. They had really convoluted use cases. Nobody could really figure out what they were supposed to be solving. And it was changing every day. When one narrative died out, they jumped to another one. If you can't very simply state a use case for an asset, it's very difficult to believe that's going to be the one that survives long term. And for Bitcoin, in the early days, when really all it was about was store of value and the debasement trade. I mean, the debasement trade got popularized recently, but that was always one of the theses around Bitcoin. That was easy to understand because it was the same reason you were investing in anything else. You just couldn't be in cash. You had to hold assets, right? When people look at the stock market, they assume all these companies must be performing incredibly well. But then if you go and actually strip out the money supply growth, the performance is about zero, right? And so you realize you have to hold assets. And as an investor, your job is to pick which one's the best, right? What asset is going to be the best one in my portfolio for me to protect myself over the long term? And to me, it was that use case around Bitcoin, the fixed supply, that really made that one unique relative to anything else that was out there. And over the years, it's just grown. My conviction around that has just continued to grow, particularly as you watch the speed the world's moving at right now. I don't think if we went back, 5 or 10 years, any of us could have predicted what's happening out there right now with all the AI and all the disruption across all these industries. You're seeing all these major name companies that are effectively getting wiped out overnight because an app released a feature, right? I mean, it's really gotten kind of crazy. And it tells you that you need to hold hard assets. And I chose Bitcoin. Doesn't mean that's what everybody's going to choose. And I think a lot of people are going to have a blend of those assets, right? It's going to be real estate. It's going to be metals. It's going to be Bitcoin, right? People get to pick what that asset is for themselves. For me, it was Bitcoin. And so ultimately, I decided to kind of go all in on that and make that my focus. And it really started in the equities markets, right, around strategy. When you were in Bitcoin for a while, the very first thing you were looking for was, when is a corporation going to adopt Bitcoin, right? When is that going to happen? And you were really looking for one that wasn't a native Bitcoin company. There were some miners and things like that were out there before strategy, but you were really looking for, what's the first corporation that's going to adopt this? And I don't think any of us were anticipating them to adopt it with the level of aggression that strategy did. I think the way we thought it was going to play out was they would just hold some Bitcoin on the balance sheet, and that would have been good enough, right? That was really all we were looking for in the early days. And so, I had this rule where in the early days, I would support any company that was supporting Bitcoin, right? So I'd make investments in any company that was supporting Bitcoin. And so right away, when Strategy made their announcement that they were putting Bitcoin on the balance sheet, I became an investor in Strategy. And then as you watch that develop and you saw the playbook evolve, it just became the most fascinating thing in the world to me, because you were taking this really traditional business and you were watching them turn into something completely different right in front of your eyes. And everyone was confused about it. They didn't know why it was working. Everyone was writing articles about the death of the company. When all the banks started going under, right? When the Silvergate and all those other banks started going under, and everyone thought that the loan that Strategy had taken out was getting liquidated, and you saw them pivot out of that and change the model and figure out ways to lower their risk profile, right? Those are the things you learn along the journey. And so you were watching this, living, breathing strategy, start to play out right in front of you, and nobody was catching on. And at the time, I felt like I was crazy, because, I was watching this and I was just so captured by it that I couldn't believe nobody else was talking about it. And so the only place I could find people talking about it was on Twitter at the time. And so I found this small community of people on Twitter. It was guys like Jeff Walton and Ryan and all these other guys that were talking about it. And we would just jump on these spaces, in the middle of the night and start talking about what Strategy was doing and going through every move they were making, every SEC filing that they would put out there. And it just became one of the most fascinating areas that I'd ever seen in business. And so ultimately, I made the decision that that was what I wanted to do, right? If you're going to work, you want to do it in something you're completely passionate about.
Yeah,
and then it no longer feels like work anymore, because you're doing the same thing during the day that you'd be doing all day anyways. And, that's what I ultimately found. And so that's what landed me in the role that I'm in now.
Yeah, no, that's awesome. Thank you for that background. I mean, we don't have we actually have a lot of, similar experiences in that regard. And you ultimately get to a point when you've studied Bitcoin long enough and deep enough, you just realize that those investors, those companies, they just operate from a fundamentally stronger position, right? And that's how I got into. I was kind of looking for the companies that put Bitcoin on the balance sheet first as well, and that's how I came across, or how Strategy became on my radar in the first place. And I think that's what we try to impress upon the commercial real estate community here as well. Is we're not sitting here making the case that you need to sell all your real estate and move to the hills, learn how to homestead, right? I mean, if you want to do that, fine, knock yourself out. But what we're talking about here is there's a new tool and a new innovation that enhances the real estate property or the portfolio, right? It allows you to make a property more resilient, whatever that means for you and your situation, market conditions, tenant move outs, vacancies, improvements, all the stuff that comes along with the business. And so I think that background is super relevant to how we all got to where we're here today. Just one question for you, Ben, before we go kind of get onto Bitcoin and digital credit, is like, when you look at the commercial real estate market today, does it feel similar to pre-GFC days, or does something feel different? I mean, I know you're on the a little bit more removed from the industry than you were previously, but just a high level observation, anything that jumps out at you?
With all markets, it seems to be narrative driven. And I felt it go in waves recently. When COVID came around, the narrative really flared up that commercial real estate was over. Everybody was going to be working from home. Nobody was ever going to go back into the offices. You weren't going to have as much need for commercial real estate anymore. And that narrative started driving kind of the collapse in a lot of the values out there. And I think we've seen over time that that didn't necessarily materialize. It did for about 2 years. And then what a lot of people found was that they actually wanted to be back at offices. There's some people that work much better, remotely, independently. But for companies, I think that there's a lot of functions that are much better served when you can have the team in person. And I think that we started to see that investment start to come back a little bit. I can't say it's materialized yet from what I've been seeing on the rent data. I've not been as close. When I was at the bank and all you would watch is the NOIs and the cap rates you were seeing come through on all these transactions that were happening. I've not been watching what's been happening with that. I don't know if the cap rates have been expanding recently. You guys might have more information on that than me. But it feels like we've at least hit a point where it's kind of stabilized a little bit. I've not felt the same level of fear that I felt maybe a year and a half ago. The headlines have died down. You're not seeing all these mega buildings selling for 30% of what they last sold for. And so I think we've kind of found a stabilization point here. Where it goes from here, I don't know. I couldn't tell you. I think you got the same thing that's happening in residential real estate right now, but that's more driven by you've got. If you look at the U.S., you would expect that the median income could afford the median house, right? That would kind of be your expectation to figure out, is a market in balance or is it not, right? Could the average wage buy the average house in the U.S.? And now we're getting back to the point where it really can't. And I think that's a massive, massive problem out there right now. And you keep waiting for the moment where that's going to give, where that's going to correct itself. And you just haven't seen it yet, right?
Yeah.
The rates on mortgages have gone up, but you've got so many people that locked into cheap capital, after the financial crisis and everything, that you can't shake them out of their homes if you want to, because they've got, 3% and sub 3% mortgages on those houses. And it's so much more expensive to roll that into something new today that people are just content to stay put. So the supply never came onto the market. So for a long time, you just had more buyers than you had sellers, and it kept driving the price up. And so real estate is just one of those fascinating markets because you continuously expect it to correct, and it's continued to not. And I don't know what to make of that yet. I got to be honest. It makes me a little bit nervous because you see all these people that are coming out of college and they're getting their first jobs. And I'm starting to see the types of loans coming out that got us in trouble in the first place. I'm seeing the billboards again for, 1% down, 2% down type mortgages. That always makes me nervous because what it tells me is nobody can afford those houses. And so you've got to come up with some way to help them qualify for that loan, to be able to buy that property, which keeps propping up the problem that you have in the market. It never kind of settles. And so I do see a bifurcation there between what I've seen in the commercial real estate side versus what I'm seeing in the residential real estate side. The residential real estate side scares me a little more right now than commercial does, just because I think that's such a problem that impacts so many people. And it feels like something has to give eventually in a major way to correct that. And I don't know what it is yet.
Yeah. To your point, the headline data points, rents, sale prices, vacancy metrics, et cetera, those have definitely kind of balanced out, kind of found a bottom to some extent, where they're recalibrating. Let's use that word. But the other side of that argument is, the scale of distress across every major MSA in the country. You have major assets, particularly in the office sector, but major institutional quality assets trading at 95 to 97% discounts, and they're not hitting the tape, right? They're not making the headlines you would expect them to make. And it's like, where are these things showing up, right? They're being just pushed down into these private equity funds and these pensions and what have you, and it becomes a bigger and bigger problem, a ticking time bomb, right? So as Jeff always says, risk is mispriced. I think about it through the lens of commercial real estate, what percentage those assets make up of some of those portfolios, And it makes me cringe when I think about how overvalued and manipulated some of those metrics are. So yeah, that's something that would keep me up at night for sure.
Cities got hit in a big way. I think COVID was a real eye opener for a lot of people who kind of got trapped there. And when when the money started getting printed and the cost of goods went way up, right? I don't care what the inflation metrics say. Go to a grocery store and tell me that inflation hasn't been much higher than what they've told us. I think people found that they couldn't really live like that anymore. And they were getting forced to move out to these more, rural type areas, not necessarily rural, but smaller cities across the country, right? You saw a lot of people moving. A lot of them came to the Midwest. A lot ended up down in Florida. A lot ended up in Texas. And you had this distribution of talent that happened out of the major cities like New York and some of the other ones that were overly expensive to live in. And I don't think, at least in the data I've seen, that that's reversed course yet, that everyone started coming back to those cities yet. And so I do think that's a major problem, and that probably does result, to your point, in a lot of that vacancy that's happening in the office space sector in particular. That one may struggle because of how concentrated that space was in the areas that nobody can afford to live in anymore. Right? To live in New York City, every time I go visit, I'm stunned by how many people can live there. I look around at what everything costs there and I go, this is crazy. Like this isn't sustainable. At least you could never get ahead. Right. Yeah. And I think a lot of people can live there and maintain, but you're never able to put anything away for the future. You're not able to put yourself in a position where, you're being protected. You've got that emergency fund or that safety net behind you. And I think that's a really difficult place, for people to be. And to bring it back to something that you said just a little bit ago, Chris, in terms of, how does this all change the way that real estate investors look at their portfolios? I think what you guys are starting to talk about here is really important because you're adding a separate hard asset into that portfolio that effectively creates a risk buffer, a shock absorber in your portfolio in the event things go very wrong. And you never think they're going to go wrong. Nobody ever does, but now we've seen it, happen several times, right? We know that's a real possibility. Last time I looked around the world, it hasn't gotten any more stable. So you have to start preparing for that. And it does change the way you look at risk in the way that you spread that risk out and try to, uncorrelate yourself from at least the major ones you're aware of. And I think that the integration of another hard asset into those portfolios like Bitcoin, I think is a great tool for being able to absorb, those shocks that can happen in the market. Like we saw during the GFC, when they do happen, they've actually tended to rebound much quicker than I think people would expect, right? Normally, if I saw a shock like the GFC, I would have told you real estate's dead for 30 years, right? That's what I would have thought, right? Because it was so impactful. But that's not what happened, right? It actually came back a lot quicker than most people would have anticipated. But you had to be able to survive that period. And that was the hardest thing, right? When the money's easy to make, people get too comfortable laying too much of the capital out. They overextend themselves into the improvements, the expansions. They're buying new buildings. They're pulling the equity out of the buildings. They're allocating it to new projects. Right? You find yourself in a materially weaker position during a time where everything's booming. And that's exactly the time things always go wrong for the most part. Yeah. And so I think if we've learned anything over the last, couple decades here, it's that you do have to continuously be mindful of where you're exposed to risk, no matter what your portfolio is comprised of. And when you take that approach and you start viewing your entire business from what type of drawdown could I sustain here, right? If I lose half my tenants for some reason, how long can I hold on to this building for, right? What assets do I have at my disposal? And I think having something like a Bitcoin forces you to put rigor into that savings allocation, right? It's an asset that you become consistently used to allocating to and building a balance around, which doesn't make it, feel much more different than operating your business day to day. It's just a normal part of how you operate. You take this money in, you spend it on improvements, you spend it on whatever you need, but then you take this small component and you put it into this asset that's not correlated to the one your main business is built around. And because of that, you build that war chest that will let you be one of the people that endures. Because if you look back, the biggest opportunity for real estate investors was that exact moment where most real estate investors were getting hammered. Right? That
You're
was
exactly
the
right.
time where people could scoop up those assets that rebounded, and that was where a huge amount of wealth was made. So you want to be in the position to operate from strength instead of weakness when it happens.
That's exactly right. And I think the bigger takeaway there is exactly what we've been kind of hammering on, the last handful of weeks, is that we're not integrating Bitcoin and Bitcoin adjacent products, to make the deal pencil to begin with, right? It's not a substitute for, rigorous underwriting. Like if you are an active real estate participant today, you still need to make sure that the deal underwrites and pencils on its own merits. From there, you check that box. Now you go figure out how you can optimize it, right? Whether it's a Bitcoin and cold storage strategy, whether it's integrating digital credit or like as we like to call it, digital rents. What role do each of those capital buckets play in a real estate context? So I'd be curious. I mean, Kenny and I talk about digital rents and digital credit all the time. We're obviously not the foremost experts in the space, but I give our audience an overview of what the heck digital credit is. What are you guys doing at Strive? And, does it compete with commercial real estate? Does it complement it? Is it both? Like how should the market kind of think through that?
Yeah, definitely. So, early on, you heard me refer to Strive as a structured finance company. And effectively, what that means is that as a company, what we do is we underwrite the risk around an asset like Bitcoin. And then, based on our underwriting of that asset, we structure products that we can bring into the market that bring characteristics that Bitcoin natively wouldn't bring itself. So, for digital credit, that really focuses on the yield aspect of it, right? Bitcoin doesn't natively provide a yield, but we can structure products around our Bitcoin holdings where we absorb the volatility. We carve off the first portion of our expected return on that Bitcoin and we return it to investors as a yield product. So now you've got, for the first time in the market, you've got a product that's backed by Bitcoin or backed by a balance sheet that's filled with Bitcoin that can now deliver to you a better than normal market rate yield. And the reason it can do that is because of our belief in what the long-term CAGR of Bitcoin is going to be. Right? So for a company like ours, we tend to look at it as a 30% compound annual growth rate asset. And so with our product, SATA, that's our digital credit instrument, we pay the first 13% of that 30% expected compound annual growth rate to the credit investors, and the excess return goes to our common equity holders. Right? And so we found a way where we can carve it out and we can bring something that's natively needed in the market that Bitcoin doesn't offer itself, which is cash flow. And so when you think about a business like real estate, and do I think that it competes or do I think that it complements? I suppose you could look at it at two different ways, right? It gives you a different hurdle rate for what your cash flow expectations would be on a project. Because if you were expecting 10% returns on a project and you can be in an instrument that doesn't give you the maintenance and the tenant headaches that pays you 13, you've got to make a decision around what the right investment is. But when I hear the way that you guys are using these products, I hear it as a very complementary product. It's a way to augment your cash flows, right? How do we find a way to create non-correlated cash flows that improve our business overall? And I think that's really interesting because it absorbs things like the loss of a tenant in a property. And if you have a product out there, like a SATA, like a Stretch, I think you guys are using Stretch right now for yours, those provide attractive yields that if you build them up over time, they make you far more resilient as a company. And so I do think that it could be looked at as either, right? We actually had it where, in our business, you're always going out and looking for how can you go borrow money if you needed to and what type of rates can you see. Well, what we started to see when these other organizations that would have historically been lenders started picking up digital credit on the balance sheet, it made them less interested in lending because they couldn't make as much on that same capital. If they were deploying that capital into a loan to 6 or 7%, or they were deploying it into digital credit, those were very different returns. And so it made them less interested in the actual lending business. So that was an unexpected response that I got to a few inquiries that I put out there. But I think it can serve both purposes. But I think right now, particularly watching the way you guys are using it, I actually think it can be a very powerful complement to a real estate portfolio.
Kenny, correct me if I'm wrong. I think Kenny and West Main, Ben, were able to increase the NOI of the storage facility by 15% by a very manageable digital rent position. That when you look at it through that lens and think through the issues that real estate has, right? Vacancies, tenant improvements, commissions. It's a very capital intensive business. So if you can say, hey, I can take tax free refi proceeds and allocate them to a digital credit position that's also tax advantage, increase my NOI. It makes me, again, I keep using the word resilient, but we have a lot more optionality on how you address or how you approach different market conditions, how you approach different situations that come up in operating the asset.
Well, I think Ben hit on it earlier when he said buffer zone. Like
Yeah.
a lot of real estate operators, they have trapped equity or dead capital really, but they leave it there on purpose. It's not because they can't refinance it and take it out. It's they don't want to risk if an anchor tenant leaves and then your cash flow takes a hit and your DSCR drops off a cliff. How are you gonna recover from that? And that's how people go belly up. And when as an operator, when we think about adding Bitcoin and digital credit, we're creating these buffers. So if anything did happen, we don't have to scramble to refinance the debt or to fill the vacancy or to do any of that. We can kind of be protected and insulated against those black swan or kind of catastrophes that could wipe us out. So I think educating the lenders, the banks, is the real challenge that we have. And they rather underwrite the taco truck that you got a lease with out front in the parking lot rather than the digital tenant like Strive or Strategy that's paying digital rents in our eyes because yeah, I mean that's it in a nutshell. So I think that's where the holdup and the friction is with the lenders, and it seems like the public markets are willing to reward these type of companies. They understand it better than the banks. They're the first adopters. Retail was first to Bitcoin, and they're first to digital credit.
Yeah, I think for the banks, the fact that these are securities ultimately will help to get them more comfortable because they're used to that type of lending, right? I think trying to explain to them things in Bitcoin terms was always very difficult. So if you were backing something with an asset directly, like Bitcoin, and you were saying, "Hey, look, I've got a Bitcoin buffer here. What type of credit will you give me for that?" Right? In terms of my overall collateral coverage, they would tell you zero. Right? They just don't want to underwrite something like Bitcoin. But when it comes to a security that holds a senior position in a capital structure of a large public corporation, it's different, right? They're willing to lend against that. The other thing that I think people overlook a lot, at least people that aren't natively in the real estate business, is you lose an anchor tenant, the loan payment doesn't stop, right? That keeps coming in. And so if you have a cash flow vehicle that augments even a portion of that loan payment, that's incredibly powerful because that's runway for you, right? That keeps you in the game longer where you can get another tenant in there. Sometimes you got to make improvements to the space before you can get another tenant in there, right? There's a lot of things that need to happen sometimes. And so extending that runway is what can keep these people in business, longer than they might otherwise have to. You don't want to get yourself into a distressed position where you have to be back to the bank in a position of weakness trying to cut a deal, right? I've been on the other side of that table. You don't want to be there. And
Yeah, it makes you more comfortable with like max borrowing, right? Like because you may be approved to do 75 LTV and you're like, you know what? I'm gonna only go 60. Because you just don't want to be in that forced position. And then another big incentive is the tax component. Like the return of capital is very powerful. I see guys talking about, the buying Bitcoin miners and it's 100% accelerated depreciation, but return of capital is like the crown jewel of tax treatment. It's like the best form of tax treatment. So it's, with ordinary rental income, you're being taxed pretty heavy. But the reason, in my opinion, why you can kind of juice these real estate returns is because there's no drag. It's 100% profit margin and it's return of capital, so it's tax deferred. And so you're swapping out ordinary rental income for a more tax efficient income stream, which is ROC.
I guess the reason the way I frame that question, Ben, as a compliment or a competitor is, I guess I probably should have drew, some lines on which product I was, referring to or thinking about. I mean, if it's a stable instrument like a SATA or a Stretch, okay, it's more of a complement. But I think of a product like STRK, right? Where, in my eyes, it's pure play digital real estate, right? The $100 liquidation value is your land, right? So the building burns down, you got that left, right? You got your 8% quarterly dividend, there's your cash flow, and then you got appreciation potential over the medium and long term. So, I mean, I find that one really interesting just from a real estate perspective. And, I think it really begs the question, unless you're an expert in real estate, right? You have an edge, you have an edge of some sort, right? And, it's no secret that majority of the real estate participants today don't, right? They got into it because they saw everyone else doing it. And, now they're an expert because of, anyway, I digress. But I look at some of the cohort there. It's like, if I have $100,000, $500,000, $1,000,000 to go deploy into some investment, and I have 5 to 7% annualized returns in real estate, everything has to go perfect over whatever your duration is, and you're making mid to high teens, right? Like, there's a ton of risk there. There's a ton of blood, sweat, and tears that go into it as well. Where now I can just put my my capital into a vehicle like STRK. That is going to be, in my opinion, that's going to be fascinating to watch play out over the next 5, 10 plus years. Is how does the market allocate their own capital, and where do they spend their time and efforts?
Yeah, I think that's a good point, right? I don't think that the products we have in market is going to be the end of the products we have in the market around digital credit, right? I think people are going to get really creative around these. Obviously we're always thinking about what other products, is the market missing out there. We simplified our structure in the very early days and said, look, we're going to just have two products that we're going to bring. One's going to be an amplified version of Bitcoin and our common equity. The other one, we want to feel very familiar. We're going for that capital stability component to it. But I think you're right that there is a way where you can segment and differentiate amongst those products based on the structure that they have. I think it makes it complex for a lot of people, right? If you're not willing to really dive into the space, which is why we opted for what we think is kind of the simplest to understand version, which is we're going to take all the actions we can to maintain this product at or near $100, and you're going to get paid every single month. And coming up, you're going to get paid every single day. And we think that that's going to be a product that really unlocks interest from a lot of investors because of that flexibility, right? It doesn't sound like that big of a difference, right? Going from 1 month to, getting paid every single business day. But when you start to actually work through the use cases out there and you look at the way different investors are treating these products, you realize that when these are the products that are becoming the infrastructure for how other people are building, giving them the flexibility of having that capital showing up every single business day of the week is incredibly powerful to them. Anyone who's managing cash flows appreciates it immediately because you're not just waiting for one chunky payment to come in, right? Bills come in every day. I've not yet got someone to allow me to sign up for quarterly rent payments. That's never happened. So, I think that change is going to be a really material one, and it's going to help us with flattening out that volatility profile and creating the most stable product in the market that we possibly can. Right now, the dynamics around these, tend to be around the ex-dividend dates, right? You get a lot of demand that comes in a few days before the ex-dividend date so that they can qualify for that chunky payment, and then you see the sell-off after the ex-dividend date. What you want is a product that naturally has liquidity in both directions. You're able to sell and you're able to buy all the time, every day, and maintain low volatility out there in the market, where that, if Chris goes out and he's got to make an improvement, to one of his properties, and he's got to liquidate some of his digital credit holdings, that he knows that he's going to be able to sell that, within a few cents of par, right? That's the ultimate goal here, is to create that really stable product. And, we're thrilled to be able to be the first ones, to our knowledge ever, to be able to offer the daily dividends, because it was just a major unlock. Because until recently, everyone was under the assumption it was impossible to do. And we were too in the early days. But when we started digging into it, we really couldn't find a reason why. It just kind of became the norm. I don't know if it was, the administrative portion of it, when you submit your dividends into NASDAQ and, you go and declare them. They don't give you an option for anything lower than monthly, in the form that you submit to them. And so I think that was just the assumption, was that that was all they would accept. And so being able to go and push and be the first company to unlock and bring that to market to us is a big, big deal. And it's one that we're incredibly proud of. And we think investors are really going to come to appreciate the frequency of those payments. You don't have to wait for your capital anymore. It's going to be there by morning when you wake up.
We're coming up here on time, and I want to respect everybody's schedule here. But there's final question for you. If you were designing a product around, right? Kenny and I have this conversation all the time. We look at all the capital that's trapped in the REIT markets, right? And just the returns that those guys are providing. It's ripe for disruption. So, your experience, knowing what you know about all this space, if you were to design a product around real estate and Bitcoin, how would you do it?
I would actually flip that question back to you guys. I would say, as people in the real estate market, what would be the ideal characteristics of a product that would complement your portfolio? What would you be looking for?
Oh, we're going to have that chat offline.
I like that. Might mean that there's a couple ideas out there. I love it. Yeah, this is one of those interesting questions, because you can look across, the investment universe, and you can find that every one of these categories is unique in the type of structures and the type of qualities that they're looking for, which is exactly why, we started with what we think is the most universally desirable product that we could bring, right? Right now, and it's a variable rate, but right now you're effectively getting better than S&P 500 returns in a return of capital vehicle with stable capital, right? A stable par price. And so far we've been holding that quite well. It's young, right? We just IPO'd this product back in November. We made a lot of changes between now and then. We took steps to shore up the credit quality around the product to make sure that the market knew we were going to manage this like an institutional offering and make sure we were mitigating the risks around our own business. But that, to us, was table stakes for these types of products. That makes it kind of a universally acceptable product. And now when you go off into all the other niches of investments out there, there's going to be ways that you can tweak them. I think institutions will look for something different. They want a little more volatility actually than what these products offer them, because they trade around it. But we'll have to see. I'm not quite sure exactly what the next structure is going to look like, but I know we're looking at a lot of them.
All right, fair enough. Tim, you want to close us out?
Yeah, Kenny, I think we have a minute or two. Any closing thoughts?
Yeah, I think, just from what I know about real estate operators are looking for two things. And Chris, you kind of acknowledged it with STRK. So I would suspect that a real estate offering would look more like STRK with some kind of appreciation mechanism and some stable cash flow. And real estate is not as liquid as Bitcoin or digital credit. So I think it doesn't necessarily have to be designed like the digital credit instruments that we see today. And I think that's what Ben was getting at. Like it's going to be fun to see how different industries draft and create these products, because each industry has different kind of needs and expectations. And I'd put my money on something similar to STRK for the real estate crowd, just because they're looking for appreciation, kind of like Ben alluded to, with institutions looking for volatility. So it's going to be fun to follow this and see what happens.
Absolutely. Well, Ben, thanks for joining us today. That's it for today's episode. If this conversation was helpful, please share it with a partner, a client, or a decision maker in the market. New episodes drop weekly. Until next time, stay disciplined, think long term, and stack sats. This is the Real Estate Standard. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market. You can find our contact information in the show notes. And as always,